We do this all the time. I mean, there are times when associations are using their reserves to take care of a problem and they're depleting the reserves, but they still can't finish the project. We come into play, we'll finish the project, but some of those funds will replenish to go back into reserves, in essence, increase the loan amount.
HOA Insights is brought to you by 6 companies that care about board members: Association Insights at Marketplace, Association Reserves, Community Financials, Kevin Davis Insurance Services, HOA Invest, and the Inspectors of Election. You'll find links to their website and social media in the show notes.
Welcome back to HOA Insights, Common Sense for Common Areas. I'm Robert Nordlund, and I'm here today for episode number 124 with a special guest I've known for decades, who I get to share with you today. Walter Block is the Senior Vice President and Business Development Officer for HOA Lending with Bank of California. They've been in the community association banking industry for a long time, and Walter is here today to tell you how an association can get a loan. Many of you know my background in the reserve study field, so I'm in the business of recommending associations set enough funds aside to prepare for their major common area repair and replacement projects. But when that doesn't happen, special assessments and loans are options board members need to consider. Well, last week's episode number 121 was another of our always popular board hero conversations. And if you missed that episode or any other prior episode, take a moment after today's program to listen from our podcast website, hoainsights.org, or watch on our YouTube channel. But better yet, subscribe from any of the major podcast platforms so you don't miss any future episodes. And those of you watching on YouTube can see the HOA Insights mug that I have here. It features a couple of board members discussing their rundown association. And that, anyway, I got that from our merchandise store, our merch store. And you can browse through that from our hoainsights.org website or the link in the show notes. And you'll find we have some great stuff there, like board member Zoom backgrounds that are free, and some specialty items for sale like the mug I just showed you. So go to the merch store, download a free Zoom background, take a moment, look around, see what we have, and look for a mug that you'd like to have and email me at podcast@reservestudy.com with your name, shipping address, and mug choice, mentioning episode 122 mug giveaway. And if you're the 10th person to email me, I'll ship that mug to you free of charge. Well, we enjoy hearing from you, responding to the issues you're facing at your association. So if you have a hot topic, a crazy story, or a question you'd like us to address, you can contact us at 805-203-3130 or email us at podcast@reservestudy.com. Now, this episode was prompted by an email from a listener in Chicago by the name of Caitlin, who asked, "Our little association is facing some huge refurbishing bills. We don't think we can afford a special assessment, so can you tell us if an association our size and in our condition can qualify for a loan?" Well, fortunately, I have plenty of friends in the banking industry, and Walter's name repeatedly came up as a loan expert that I should have here on the program. So, Walter, welcome to the program, and how would you respond to Caitlin?
Well, I first would respond to her, how many units do you have in your association? We have a minimum requirement of 25 units, and if it's less than that, unfortunately, the way we do these HOA loans, it wouldn't qualify. But if it's over 25, we can handle it.
Is that just Bank of California, or is that pretty consistent across the industry?
It's standard across the banking industry. It's just very hard to underwrite a loan with those few units when the only collateral that we have is the assessments and or special assessments. There's no real estate involved in these HOA loans.
That's right. You're not attaching, like in my mortgage, the loan is secured. That's it. That's the right word. Secured by my house. If I stop paying my mortgage, the bank will get my house. So the security for an HOA loan is the income stream. Is that it?
It's the assessments is what it is. And there's no secondary source of repayment. So many of the major banks wouldn't be doing these loans because they look for secondary sources of repayment. But in the industry, the successes of it based on these are people's homes, they live there, they're not going anywhere. And as long as we underwrite it with our, let's say, underwriting credentials,
Right.
we're fine. And I mean, not every association can qualify. There's certain situations with delinquencies, owner occupancy, so forth, that might trigger it to not be something that we can do.
Let's go down that path again. If the association is under 25 units, then that's probably going to be a disqualifier. You talked about delinquencies, owner occupied. Talk to me about those factors. What are some rough numbers?
Delinquencies, if it's over 8% of your total annual revenue, it's a problem. You'd probably have to work to get rid of some of the delinquency.
Okay.
Owner occupancy, if it's under 50%, it's also negative. It depends too sometimes on where the association is located. Let's say it's near a university or in a town where it's right in the area of a major company. Maybe we can make some exceptions, but those are basically guidelines that we use when we underwrite.
And that's why you come into play, because you've been doing this a long time and you know what the nuances are. You know what a well-performing loan is, and you probably get a sense when you look at the paperwork on what a application is that's probably not going to make it.
I can pretty well tell right away, yes. And also we need reserves. Reserves are a big part of the association in their health of it. There are times for the association with other factors are okay that we can lend additional funds to put into reserves to make the loan work. That is, again, it's actually borrowing more money, but it takes care of the issue.
In my mind, if an association needs $500,000 for a new roof, but they have a $200,000 asphalt project coming up in a couple years, then you may say, yeah, let's make this not just a $500,000 loan, but a $700,000, and maybe even add a little margin for the carpeting and the hallway paint and things like that.
That is correct.
Okay.
Yes, we have to look at the reserve study and what are the upcoming expenditures that the association needs. And if they're only doing one item and there's 2 or 3 big items coming up in the next year or 2 years, we have to get those taken care of. And that's why we look at those reserve studies carefully on what needs to be done in the association.
Walter, that's music to my ears. We provide reserve studies so board members know what's ahead. And in those cases, as I said in my introduction, where the board finds out that, gee, the boards before us just didn't have the courage to set funds aside, and now we're left with an old roof, old asphalt, building needs painting, the boiler is on its last legs. Boy, that can be a daunting situation. And that may be more of a special assessment than the owners can afford in one fell swoop. So that's when it comes time to talk to someone like you. Is that right?
Correct. And we do this all the time. I mean, there are times when associations are using their reserves to take care of a problem and they're depleting the reserves, but they still can't finish the project. We come into play, we'll finish the project, but some of those funds will replenish to go back into reserves, in essence, increase the loan amount.
Got it. So let's go back to that hypothetical from a moment ago where they have a $500,000 roof project. Let's say they have $400,000 in reserves. So they may not need all of that money for the roof project. They're going to balance spending some of their own money, some of the bank's money. That'll minimize the total amount of the loan. That'll basically give them a boost to get through the next 5 or so years.
Well, that's part of it. But then again, we look at maintaining a certain reserve level during the term of the loan in the neighborhood of 30 to 40%. So you can't deplete your reserves too far and still qualify for the loan, maintaining a good reserve level. So that is part of the underwriting that we do.
Excellent. Okay, so you want to make sure that they're not just bouncing along the bottom of their reserve fund, that they've got some kind of margin.
Well, part of the lending, if it's done right, is creating a good balance for the association to take care of what they need to take care of during that term of the loan and may be able to, and making those payments. So it's a fix if they have not done things very well in the future, in the past.
That's great stuff. I say that again. You're creating a good balance of having available funds and the cash flow.
Will take care of itself. I mean, thank goodness these loans are there, because to put assessments to everybody for large amounts is not the answer. And these loans temper it. Now, people can always pay their assessment in full, but not everybody can do that. So this allows the association to get this done without least impacting all the members.
Well, let's talk to me about that. You said some people can pay it off, but yet it's a loan to the association, not the owners, right?
That is correct.
Okay, so if it's, and let's just make some rough numbers. What are the rough numbers? Let's say a $500,000 loan and a 50-unit association. That's 10 grand per. Okay, so if owner number, let's keep the numbers consistent. Owner unit number 5 says, I don't like this loan hanging over me. He can write a check for the 10,000 and his unit
That's
is
it.
free and clear. Okay.
Well,
So it's
he's not involved in the loan per se.
got it. Okay. So the association is still has a loan with the bank, but automatically their balance just went down by 10 grand because unit owner number 5 paid off their portion.
Right.
Nice. Okay. So it's an interesting combination of the association have the obligation, but owners as shareholders, they own 1/20th or 1/100th or whatever it is at their association. They have a piece of the action in that. You also mentioned being concerned about the cash flow during the term of the loan. What is a typical loan term?
Typical loan term is anywhere from 5 to 15 years. And it depends again on the dollar amount that they're going to borrow. If it's a $2 million loan, it's generally 15 years. $1 million loan can be 10 years, and then it goes down. But I would say the average of all the loans that we do is between 10 and 15.
And you probably don't want to go longer than that because you're lending for roofing and painting and asphalt, and you want to get that paid off before it happens again.
Correct. And we don't do longer than 15 years. We'll do a 1-year interest only. So effectively the loan is 16 years.
In case some of the owners want to pay off their portion, then they can get in and get out. And
during an interest only period, they can do that.
Very nice. Very nice. What is a typical, you talk about no interest for maybe the first year. What is a typical interest rate?
Typical interest rate today, I'm going to say probably between 6 and 7%, depending on certain situations. We look at the management company also and deposit balances and so forth. But that's just a wild range. We rarely do loans at 6%. So I'd say the average is like 6.5%.
Got it. Okay. Well, for people in the future that are listening to this episode, we're recording this in July of 2025. Someone in the future is in a period of high inflation and the average mortgage is 12%. I'm sorry for you. But so we're talking about 2025 numbers here. We're typically talking about, I guess, reserve projects that the association is confronted with and they find out they just don't have the money for. Is that a fundamental assumption to start with?
Pretty much.
Okay. So
sometimes they have projects that they want to do that are not quite in the reserve study, that they want to enhance the property. And we can do that too.
Okay. Like a large HOA may want a nice new entry monument
Yeah, I was just gonna,
situation with a
I was just,
fountain and
I was just gonna say that. And
okay.
yes, and that is acceptable also. It doesn't have to be in the reserve study. And then there are items now, especially in California with the balconies these days that these were not in the reserve study. So they have to be handled separately, and most people have to borrow on that going forward. So, we've had situations in California with pinhole leaks in the pipes. That's not specific in the reserve study either. So there are items that come up that the association, all of a sudden, we need to take care of. And thank goodness, banks that do this, we have loans to take care of.
Yeah, that, again, thank goodness. When you talked about that, in California, there's a law that says the exterior elevated elements, wood-based structure, need to be inspected every 9 years. And in Florida, there's the structural integrity reserve study. In different areas, there's different structural type things. And yes, every once in a while, an association will get surprised by something that wasn't picked up in their reserve study. It was outside the scope of a reserve plan. Maybe it was hard to identify, a plumbing situation. And that's when they can be confronted with a big bill and wonder, how the heck do we manage forward? And that's when you call a bank that's familiar with this nuance of how we lend to people that don't have, well, yeah, you can't attach the clubhouse because the bank can't sell the clubhouse.
Well, we don't want the swimming pool either. So,
The swimming pool brought to you by Bank of California, um, courtesy of Bank of California. No, I get that. Let's say more of a classic situation where it is a reserve project. Okay, you've seen it coming. Maybe they didn't look, they didn't care, they didn't have the courage to confront the question, but now they've got a roof, and last time it rained, it leaked, and they know they have a problem. And no one there can remember the last time they got a new roof, so they know it's old. How long does it take to qualify? Is it months? Like, are they just up a creek without a paddle, or can you turn around an application and get a roofer hired?
we can do that, but I would say generally from the time we get an application and we review it and feel that it's something we can do, and we get all the, let's say, financials, reserve study, and so forth, probably 3 to 4 weeks would be the max to get loan approval. But then again, they need to get a member vote and possibly a special assessment to help with the loan payment. So that's going to take additional time.
Got it. Okay. My brain is spinning on a number of different questions, but I look at the clock here and we do need to take a break. So let's do just that. Let's take a break and hear from one of our generous sponsors, and then we'll be back with more questions about lending and providing more common sense for common areas to our listeners.
Is your HOA or condo self-managed and you don't want to work as hard volunteering? Are you full managed and looking to save money? Or are you looking to split the accounting from a manager's role for better service? Let Community Financials handle the monthly accounting for you. We collect dues, pay bills, produce financial reports, include portals, and help with other support services, all while providing awesome service. We'd love the opportunity to help you make your community accounting stress-free with our industry-leading systems and expert team. Visit our website, communityfinancials.com, to learn more.
And we're back. Well, I was talking to Walter about how he has become the answer man, and he's been in this industry for a long time. And I've been in the reserve study industry for a long time. And Walter, isn't it just kind of fun to have people come to you with questions like this?
It is. If you've been in it long enough and people know you, they call and ask questions. And I'm happy to answer it, to help them to do what it is. I go to meetings. I will meet people at board meetings, town hall meetings, and all that to go over it. And the whole idea is to make sure that everybody understands what we're doing. And when they buy into it and they realize the benefit, getting a member vote is not that difficult. So this is where you become a part of that association. along with the manager, the management company, and so forth. When we do these town halls, their attorney is there, the contractor's there, I'm there. They get a whole picture of this really needs to be done. Nobody's trying to throw something to you. This needs to get done, and here are the options. And once you know the options, you go forward.
Yeah,
And
I
that's
like that.
what it is.
Yeah, I like that. Board members have a hard job, and to be able to, even in a tough situation where you have a big bill and no money, once you get clarity and you get the right people together on the team, then you do have a path forward. And you've done this hundreds or thousands of times, and you know what the steps are. Let's return to that, where we talked right before the break about it can be done within, it sounds like if everyone is coming together on it, it can be done within a month, that kind of time period. It takes paperwork, member vote, and boy, if you have a leaky roof and the evidence is clear and you have a contractor who says, yeah, it's going to be $500,000. The reserve says, yeah, that's about what it needs to be. That's what you're talking about, getting a member vote, sometimes a special assessment, like you said, to get a little bit of extra cash. What else is involved? Are there any other kind of surprises, or is that kind of it?
Surprises can be once they get in and start doing the work and they find other areas that they didn't anticipate, that can create a problem where all of a sudden they need additional money. And it happens not all the time, but maybe 10 or 15% of the time where they find something that nobody anticipated. Go into a wall and all of a sudden you find wood that is deteriorated. If you're on the coast somehow and part of your association doesn't face the water or the ocean, their units are a little bit more complete than one that's been battered by sea breeze and water and all that.
Yeah,
And
salt
when you
air for years and
salt
years and
air
years.
is horrible. And so all of a sudden, those group of units needs a lot more work and they find things. And all of a sudden, instead of a $2 million loan, you need another million. The bank has to be open to helping that association to do that. And it's happened maybe 20 or so times that we have to do it. And we generally can. They may need some additional reserve funds. We can do that too. But it's part of the program. And I'm never surprised by something that does come up, but you have to be ready to handle it. And that's the key part.
I like that. Never surprised that it doesn't go perfectly.
Right.
And that's a big number,
It is.
20% or so.
Yeah.
That's a lot. Okay, so you've done this a lot. Let's go back to, you told us that some people could pay their portion early. Are they paying as part of their normal monthly assessments, or do they pay to the bank? Who actually is paying the loan back?
The management company pays from the association's cash that they have. They are the ones that send us the funds, or we have an auto debit to their account and we go from there. And that's how we get paid. The people that are members, if there's a special assessment, there'll be two line items on their bill, one for the monthly dues and one for the special assessment that they have that is for the loan. And that goes directly into their account, and the management company takes care of seeing that we get the payment.
Is it common that, and I'll use some other kind of hypothetical numbers, let's say the association's monthly assessments are $375 a month, okay? And they realize they need a loan. Is it common then that you're going to say, hey folks, to manage the loan payback, you're going to need to go up from 375 to 425 or something like that, something to positively increase their cash flow? Or do you handle it as a long-term special assessment payback?
Long-term special assessment is a separate line item that is separate from their dues. We don't do anything with their dues. That's up to the board and the association. But we will then have a payment for the loan that generally comes out of a separate account. And then the other part is that when we do these loans, we ask that the association open a separate account strictly for this work to be done. So everything that is part of this work, every cost goes into that account and out of that account. So if there's ever any question about where did the funds go, it's all through one account.
Got it. That makes perfect sense. That makes sure it's all very clean.
Yeah.
And, Walter, we're dealing with humans here. And there's going to be some people who say the board is skimming, the board is putting some of that money in their pocket. And by golly, if you have one account where the $2 million came in from the loan, and then the special assessment is paying that off, and then the money comes out to go to ABC Roofing, there's no question. It's just nice and clean. I like that. Okay.
And that's the only way that we do it. It's just saves you so many other issues. And all you need is one member of the association complaining about this and that and wants to see the information, wants to see the statement, the counts, and all that. Well, it's so simple if it's one account. But if you paid from another account or this account or operating funds came in, it creates a nightmare. And you do not want to have that happen.
Yeah, it's probably enough of a nightmare that the roof is leaking and you don't have the money. You don't want to add organizational nightmare and political chaos. Yeah, I like that. I hope that was someone's good idea long ago and not a bunch of situations that went sour.
I can only tell you that way back when there were a couple that did. They deviated, but normally that doesn't happen.
Yeah, you've learned that let's do it nice and clean, and that way we want. Yeah, because again, this is what you do day in and day out. Back in 2021, we had Champlain Towers South, and that collapsed, and just a tragedy in Florida. We've been talking about the last few minutes about a roof that's leaking, or the asphalt that needs to be resurfaced, or maybe the building needs to be painted, or an elevator that is getting unreliable. What did the collapse of Champlain Towers South do to the banking industry, the lending industry?
Probably a lot, especially in Florida, but a lot is now having areas more reviewed or inspected. Here in California, balconies, if you remember, there was a balcony collapse in Berkeley. Kids were on it and a lot of injuries, I think even a fatality.
I think we had a few fatalities.
So the issue is we need to inspect it. Everybody needs to do this and that, and it has to be done by a certain period of time. Okay, that we didn't expect. So there's funds that need to be done for that. And so a lot of people have looked at their reserve study and said, well, we have this project, we'll include the balconies, we'll do this. So let's get a loan. And so those are things that happen, and it's just part of having a building, and you have to take care of it. If you own a home by itself, you have expenses you have to take care of, and they come up. And the association, that's going to be there, but thank goodness you have a loan that you're not having to come out of your own pocket every time.
All at once, yeah.
Right. So this gives you some comfort that can be done, but you need the board to take care of the finances and monitor it and have good meetings and so forth. And if it's run right, you should have no problem getting financing when you need it.
I shake my head when I think about Champlain Towers South, because that made such a difference here, in that it goes from a leaky roof to lives at risk.
Yes.
And it's nice to know that there are resources like getting a loan so that in addition to building envelope issues, the building access issues like an entry gate system, the amenities that you found attractive to make you want to have this place be your home. Also, you want the balconies to be structurally intact. You want the elevators to run reliably. There's so many things. And I think so much of our audience needs to get comfortable with the fact that owning real estate is expensive. And whether it's ongoing assessments or special assessments or a loan, owning real estate is expensive. Is that kind of what you end up thinking at the end of the day?
Yes. There are unfortunately people that buy into a condominium association. They think as long as they pay their dues, everything's fine. Well, unfortunately, it's not always that way. So you have to understand that there can be things come up. So you're all there together to do it, work together to get it done. And that's it. Don't fight everything, because dues itself and what you contribute to reserves doesn't always take care of everything you need to do.
Well, you said it just a few moments ago when you're talking about having that town hall meeting and everyone's very clear that the roof is leaking, the roofer is there, the attorney is there, and it's very clear that this is what we are dealing with here at our association. It's a community issue. It's not the board members being nasty. It's not the manager being a pain in the butt manager. It's our association and the roof is leaking. What are we going to do with it? And that whole idea of community. Sometimes a tragedy can unify a community. The tragedy of not having enough money for the roof. At least it gets everyone on the same page. I like that they're all there.
Well, it's the way it needs to be done. And it works. Let's put it that way. It works. And everybody is, once it's all done, you go, we should have done that 5 years ago. That's kind of where it is.
Yeah. Good. Okay. Well, thank you, Walter. It's been great talking with you today and having you on the program. Any closing thoughts to add to wrap up our conversation today?
No, I think it's just a good industry. It's needed. And if it's handled right, everybody's going to be a winner on this. And that's where it should be. It can be. And it has been. I think everybody go forward and look at these things as positive to get work done and keep your association in good shape.
I like that. Get the work done and keep your association in good shape. And yes, it does take money. If you'd like to get in touch with Walter or learn more about lending at Bank of California, you can email Walter at walter.block, B-L-O-C-K, at bankofcal.com. And I'll have this in the show notes, but it's BANC of cal.com. Go to their website at bankofcal.com. Again, BANC of CAL.com. Well, we hope you learned some HOA insights from our discussion today that helps you bring common sense to your common areas. We look forward to having you join us for another great episode next week.
You've been listening to HOA Insights, common sense for common areas. If you like the show and want to support the work that we do, you can do so in a number of ways. The most important thing that you can do is engage in the conversation. Leave a question in the comment section on our YouTube videos. You can also email your questions or voice memos to podcast@reservestudy.com or leave us a voicemail at 805-203-3130. If you gain any insights from the show, please do us a huge favor by sharing the show with other board members that you know. You can also support us by supporting the brands that sponsor this program. Please remember that the views and opinions expressed in this program are those of the hosts and guests, with the goal of providing general education about the community association industry. You'll want to consult licensed professionals before making any important decisions. Finally, this podcast was expertly mixed and mastered by Stokelight Video and Marketing. With Stokelight on your team, you'll reach more customers with marketing expertise that inspires action. See the show notes to connect with Stokelight.